research think tank, and we believe in research-based policy advice. We have been doing policy-oriented webinars for almost a year and a half now, and very fortunate to have the best minds across the world to come and speak to us. Today's webinar is now focused on India 2047. As was the last week's, today we are focusing on NBFCs. Last week we had done it on insurance. Next week we are going to do it on banking. And for 3 weeks after that, we are going to stay focused on India 2047. Basically, what we are trying to do is when the Prime Minister talks about 2047, we are trying to bring to his notice various sectors of the economy and what the experts in those sectors think India would be in that sector in 2047. To chair this session, we have with us Professor Ashima Goyal. She is a well-known figure. Earlier, she was with the Prime Minister's Economic Advisory Council, and right now, she is in the Monetary Policy Committee of the Reserve Bank of India. Professor Ashima has been with IGIDR for many years. She has published obviously extensively, both in referee journals and otherwise. You should look up our working paper series. They're so interesting. With this, I hand over the session to Professor Goyal.
Thank you, Charan, for the invitation and the introduction. And I must say, EGROW is doing a very good job with these webinars, so regular over so many weeks, with people from abroad, from different regions of India, from now different financial institutions, and really thinking together and collecting points of view from practitioners is the best way to design policy. So very valuable policy inputs also. The NBC is a very interesting sector. We know that India's credit ratios, credit GDP ratios, are among the lowest in the world, among its peers, even other emerging markets, for the private sector and for households, private, corporate, and households. Indian government debt is slightly higher compared to the East Asian peers. And India by 47 definitely has to have much higher credit GDP ratios. And NBFCs will have to play a major role in this. Already we saw what they could do because there was a boom in the last decades, especially after 2014, a boom in credit from NBFCs. And we saw that during demonetization, because a lot of very cheap short-term credit was available, cash was deposited in the banking system. Then there was an asset liability mismatch since NBCs were borrowing short to get cheap funds and lending long. And for that and other reasons, there was the ILFS crash. And we saw how, as credit growth from NBFCs crashed, we saw how economic growth also crashed in 2019, just showing how important the provision of credit from NBFCs had become. And that time I remember I was writing saying that this sector is important, it's systemic, and it must be given lender of last resort facilities, which unfortunately it did not have at that time, and that aggravated. As economists, we know that there are cumulative kind of downward spirals, and this is something of what we saw in the economy. But going on, in generally worldwide, the belief was that because India's financial sector is stressed after COVID-19, things will get much worse. But the financial sector has surprised many analysts, and it's really turned around. NPAs have come down for banks as well as NBFCs. Recoveries are really good. Capital buffers have been built up, and they seem ready for a growth phase. And they seem to have learned the lesson because although again, as liquidity expanded, short-term credit was available cheaply, one of the latest FSR showed that only 3 NBFCs had a large exposure in commercial paper, unlike earlier. So, but when we are looking forward to 2047, and you're seeing what is the design of the sector and of regulation, then the basic problem is that there are very few NBFCs who are allowed to take deposits. And because of this, that means that, deposit takers aren't at risk, depositors are not at risk. So there was less regulation and regulatory arbitrage, which helped NBFCs be profitable. But if we recognize that they can be systemic and regulation has to be tightened, then what are going to be the sources of funds and of profits? If liquidity ratios are imposed, one of the arguments against giving LOLR is that they don't have GSECs and so on. Then they will need to keep more GSECs, and a suitable lender of last resort could be imposed. But to decrease costs of lending, they have to, because India is very diverse, so they have to rely on tacit knowledge, on developing risk-based lending, on customization to suit MSMEs. So, and possibly one answer the RBI has been exploring is regulation by scale, which is stricter for larger deposit taking and systemic NBFCs. But I think apart from regulation, what is very important for the NBFC sector itself is to improve corporate governance, which will make it easier for them to raise cheaper funds through the bond market, to enable them with higher ratings. It will enable them to get cheaper bank loans, and they can lower the cost of lending through fintechs, co-lending with banks and fintechs. And banks, if they know the NBFC well and are partnering with it, would give cheaper loans, presumably. And so maybe we can think of, sometimes, again, feedback from the industry is very valuable here. What are the kinds of regulation, self-regulation, corporate governance? If that improves, then other kinds of intrusive and high compliance cost regulation can be decreased. So this, again, feedback from the industry would be really useful. And we're already seeing that as regulations are tightened, the HDFC bank merger with its NBFC, that is one way that the larger NBFCs perhaps will go. By 2047, we'll have more of such mergers. But then some foundational changes are taking place now that are going to impact us in 2047. Big changes, increasing role of digitization, its role in finance, which enables cash flow based lending, much better types of data that can be used. And here, another question I want to flag, and I would love to get inputs from our very, very knowledgeable panel, is that since as NBFCs lend to MSMEs, do they see greater formalization going forward, which will enable MSMEs to get loans more cheaply? Or are they going to ask, because recently regulatory tightening, there was this view that since you lend to small MSMEs, there should be less regulatory standards such as classification of standard loans when everything is repaid and those sort of things. So going forward, is formalization and better accounting standards, etc., important, or giving, allowing MSMEs some leeway? And what are the other new directions? So I now look forward to hearing from the panel and learning from them. We have a very balanced panel with a good view overall of NBFCs, of finance, of digital platforms, of financial services, of risk. So we will start with Sri Raman Aggarwal, who is the director of the FIDC, a representative body of NBFCs, as well as working with a major NBFC, Shrey. And he has won many awards for his leadership and devotion to the NBFC cause. So perhaps you can take 12 to 15 minutes and we will go along. Please.
Thank you, madam. And foremost, I must thank EGROW Foundation for this wonderful webinar and giving me an opportunity to share. I think, madam, before I start, I must place on record my sincere and very long inspiration I draw from you. And I think your very short and crisp talk today has further strengthened my point, because you have actually touched upon the real points, if I can call them, some of the pain points and some of the strengths of NBFCs. So I would like to address the subject of how do we see NBFCs in 2047. I will break it up into 5 parts and address them quickly and finish within the stipulated time of 12 to 15 minutes. First, of course, is we've seen often, whenever there have been any challenges in the system, whether it was the global crisis like the 2008 economic crisis or the global pandemic since 2020, the COVID, or whether it was NBFC specific sector challenges like Ashimaji mentioned about the ILFS crisis 2018 or the 1997 crisis when this entire saga of NBFC regulation started, or the 2014 scenario where the entire regulatory framework was overhauled, we have seen this question crop up about the survival of NBFCs. And I think NBFCs have shown and proven that they not only have, I would use the word iron to survive, but actually come out stronger every time such challenges are posed. And I think history speaks for itself. So number one, I want to put it on record my unequivocal and very strong belief that by 2047, NBFCs will be very much there, not only be there, but as Ashimaji also mentioned, perhaps play a very, very increased role in credit delivery in the Indian market. That's point number one. Now, the next question obviously comes, what is it which leads strength to this NBFC sector? So I think the key element of the business model or the nature of NBFC's lending has been their ability to quickly adapt and change to the changing market dynamics, changing regulatory environment, changing policy environment. And it is this quick adaptability, I think perhaps fits into the Darwin's theory of survival of the fittest, or the theory of evolution, quickly evolving to adapt to the new scenario and serve the bottom of the pyramid or the unbanked segment of the. So while we may see this, and this is going by the fact that NBFCs provide that need of flexibility in their lending, and I think that has been the key to NBFCs being able to cater to the unbanked segment, to the underbanked segment, or even, as we know, to the MSMEs, because there some amount of flexibility is important and is required. The third aspect is, of course, the regulatory or the policy environment. Now, this is where perhaps there comes one of the most, I would say, the biggest challenges. Now, this again, I will break into two parts. One, of course, is and rightly so, the policymakers and the regulators view to that we need to align our norms to the global norms. We need to have kind of an aligning and not be totally disaligned with them. And number two is also the need to harmonize the regulations between various lending institutions operating within the country. Now, the first part, when it comes to need to align to the global norms, I have a view that by 2047, and I think the great economic minds like Ashimaji and Dr. Charan Singh here sitting would say perhaps by 2047, we may well see India turn into a developed economy. And I think that is where I feel that our say in the global so-called formulation of global norms would be much more, and we may find a much more Indianization to that extent, if I may use the term, of the norms which actually are driven by the need of the borrower. So that is where those flexibility element will kick in. However, when it comes to harmonization, yes, there seems to be a distinct and a logical challenge, but I think this would be more addressed by, I would say, the role of technology. And how that will happen, I think I will come to the next part the moment I talk about it. Fourth part is, of course, the role of technology, and that is where I would bring in the much talked about, or the fashionable word today, the fintechs. I would like to present a different side of this story. I think the genesis or the way fintech word is coined is simply a company which is a technology-based company providing technology in the financial services space. So it's a fintech, that is the word. However, rightly or wrongly, the way many of the fintechs work and are perceived are more becoming lendtechs. That means technology-driven lending, purely lending, rather than the entire financial services gamut. And that is where some of the challenges have also crept in. And we see regulators stepping in terms of setting up, we've seen a task force being set up, and shortly there's going to be a kind of a regulation prescribed for digital lending. So I think the fintechs probably would do a far greater role and will have a greater role in providing technology-based solutions to build bridges between various lending institutions. And this I would straight away link to the fifth part, which is how do we see in the scenario in 2047. Now, in 2047, I perceive, I go by a very famous scholar who once said that 19th century was an era of dependence where we saw heavy colonization happening across the world. 20th century was an era of independence where all these colonies got independent into independent sovereign nations. And 21st century is an era of interdependence where these sovereign nations are talking to each other. So I think the same we are seeing creeping into the financial world. We are seeing a lot of collaborative things happening. This was obviously given a big boost and a big, I would say, kickoff by the idea of co-lending, which was mooted and floated by the Reserve Bank of India, and for which Reserve Bank must be given due credit. And I think this has really kicked off and opened a whole new world where we see a tremendous opportunity of cross bridges being built, collaborative models being built between banks, financial institutions, and NBFCs. If today we are talking of co-lending, I mean, hypothetically going ahead by 2047, maybe we can have a model of co-borrowing. And Ashima ji mentioned about fixed deposits from public. RBI's concern is that they want to allow only banks. What if there is a co-borrowing of deposits by banks and NBFCs? I'm just throwing on the table. So the idea here is that the real situation would lie in terms of building bridges. Again, drawing parallel from what's happening in the political world, while we had an era of the NATOs or the non-aligned movements or the SARCs and the ASEANs, today we are seeing more collaborations, and we have the arrangements like the BRICS or the Quad, which are cutting across geographies. If you look at BRICS, it covers practically South America, South Africa, Europe, Asia, Indian subcontinent, and China. So practically we are cutting across the globe, and we are seeing collaborations happening. Similarly, we will have bridges being built across, collaborative models being built across between banks, NBFCs, public financial institutions, even Reserve Bank. I mean, I think when Ashima ji mentioned about Reserve Bank acting as the lenders of the last resort facility, why not? I mean, that is another example of how RBI as a central bank can also pitch it. So I think the key here would lie in building those bridges. I'll stop here. Thank you.
Thank you. Very, very good points. In fact, this Indianization of global standards, like, the chocolate standards set in Geneva imposed on us, and we have much higher, hotter countries, so it melts. So, I mean, and then India is going to be a very large part of Asia generally, is a very large part of total GDP now. And yet the standards are all European and US West based. So all that needs to change. This co-borrowing is a very interesting idea. So now we go to the next panelist, Radhakrishna Thatavarti, who is CEO and founder Oxy Loans. So has passion for providing facilities to rural, bridging rural and urban. And with digital innovations, we foster.
Yeah, thank you. Thank you, Ashima ma'am. Check. Am I audible?
Yes.
Thank you. And thank you very much to EGROW for giving me this opportunity. And I'll straight away get into the point. P2P NBFC. If you look at today, we should thank RBI for considering the peer-to-peer NBFC. What is peer-to-peer NBFC? I'll talk in the next slide. Hope all of you know. But with the invent of peer-to-peer NBFC, I feel every individual is a bank and every store is a bank. How is it possible? We'll see in the next slides. So it already started. 2047 looks to be very, very opportunist for the lending space. Currently, we have 25 peer-to-peer NBFCs approved by RBI. Okay, sorry, some request has come and I have accepted it. Okay. Okay. So currently we have 25 peer-to-peer lending NBFCs approved by RBI. 2017 is the one peer-to-peer NBFCs white paper launched by RBI. In 2018 and 19, 21 companies received RBI licenses. Currently, the market size is 1 billion in India for peer-to-peer lending. But however, the future looks to be 100x potential for the growth. Now, I trust this will happen very soon because of the financial inclusion and because of the technology. I see that every store is a bank powered by technology. As Ramana Aggarwal sir said, the bridging is very important. So we feel that because of the peer-to-peer license that RBI has given, which can be enabled for the technology, okay, and every store in the rural, every store in the urban can act like a bank with the peer-to-peer loans and peer-to-peer investments. The credit bureau availability and GST score availability will only give a larger opportunity for any individual to understand how to lend money like a bank. So today, lending and borrowing is very traditional affair in the Indian market. Lending was there from long number of years, which got into the RBI hands, and then today we have good regulations. So this is what I visualize. Like no, every store has a bank, and every rural or every village will have a kind of outlet where they offer peer-to-peer lending, and NBFC services will become word of mouth. So what is peer-to-peer lending? Quickly understand, I as an individual can lend money, you as an individual can borrow money. So the peer-to-peer lending is all about any PAN card holder lending money and any PAN card holder borrowing money with a clean KYC and completely online. So the technology is playing a vital role as we speak today. And last 4-5 years was an amazing years for the technology to prove that it can bridge any level of chasms. Okay, and why become an investor or a lender in P2P? Today we are seeing that peer-to-peer lending platforms, technology platforms are giving anywhere returns from 12 to 23%. In peer-to-peer lending, what we say is subject to recovery risk. It is not just about the market risk, but subject to recovery risk. What is happening? Is there a guarantee? As per the RBI guidelines, there should not be any guarantee on the loan. However, when you invest on the borrower is actually giving the checks and the promissory notes of 2x. If a lender is giving 1 lakh, the borrower is giving 2x. That's the kind of assurity and guarantee that the borrower is bringing into the system, but there is a subject to market risk. Advantages of peer-to-peer lending. The risk and reward is shared. Like no, today, in most of the platforms, you can actually access borrower who wanted to pay 12% per annum, 24% per annum, 33% per annum, which is equal to a credit card rate. And if somebody fails to pay the credit card on time, it goes to 40, 48, 60, up to 60% is the interest rate charged on the credit cards. So peer-to-peer platforms also adopted the same model. The lender is taking the risk. The lender is fed with loads of information. There's a lot of AI work and analytics work happening on the data. So every borrower comes with either is a salaried borrower or SME borrower or a large corporate who comes and seek money on the platform. So there are enough AI rule engines built by the platforms to understand the risk. So disadvantages, it's completely unsecured. And another disadvantage is borrower cannot borrow more than 10 lakhs. A lender cannot lend more than 50 lakhs. So that way the risk is quite distributed. And absolutely there is no insurance and no protection to the investors. We try and fix it with various accidental insurances and life insurances, but willful default, there is no coverage. Obviously, the insurance industry and then loans industry cannot survive if there is a insurance for the willful default. Yeah, limitations as we discussed, 1:1 is 50,000. If a lender wants to lend money, he can only lend 50,000 to one borrower. However, the higher limitation is 50 lakhs. His returns be taxed. On the face of it, when the borrower is paying the interest and principal, the interest is not taxed. At the end of the year, a lender has to tax, lender has to show his income on his own and pay the tax. Quickly looking into the how, if you look at last 3-4 years, the age of peer-to-peer lending is just, I can say, 5 years. And with RBI coming and giving the licenses, it's only 4 years. And with pandemic, you can actually discount 2 years. We are very at a nascent stage. Why the peer-to-peer lending is going to lead? Today, I am talking about the peer-to-peer lending will lead massively, and actually banks and NBFCs will become a facility units, because in peer-to-peer lending, I as an individual can lend, I as an individual can borrow money using the technology anytime, anywhere. Absolutely no limitations and no restrictions while we follow the RBI guidelines. So why people see, many times people ask those questions like, no, banks are giving money, friends and families are giving money, NBFCs are giving money, then why the peer-to-peer lending, a new class of lending? So till if you look at out of the 18 loan applications, 17 are getting rejected by banks. Only few of them are picked by NBFCs, few of them are picked by RBI, friends and family. Rest are always not addressed. Why they don't get loans? 50% of the DBR is challenge for them. An employee who is getting a 1 lakh salary in IT field, especially, they already have a 35,000 worth of EMI on home loan and 10,000 worth of loan on the car and some 2,000 insurance payments. So 50,000 straight away monthly deductions. So that is making not to get the loan from the standard banks. So SMEs are struggling and lenders are open to take risk. The people who got money, they are still not happy with the mutual funds. They want a different asset class which can give 2% per month. In our peer-to-peer lending, what we see is there is a huge class of people who expects 2% per month returns. All of them are coming onto our platforms. 2.0, if you look at 2.0, the peer-to-peer lending platform slowly learned the art of getting into the supply chain, because in a supply chain, there's always a manufacturer, entrepreneur, and then bank, and then machinery. So there is a kind of security. However, the loan is unsecured, but the fund is not going to buy a bike, or the fund is not going to buy a vacation. The fund is not going to buy the uh, iPhone kind of unnecessary for the lower and middle class economy. Okay, so this kind of supply chain where there is a manufacturer, dealer, distributor, and where there is a revenue, this looks to be a safe haven for the peer-to-peer. Now, if you look at 3.0, this is a big time. This 3.0 is going to take us to the 2047. Like the entry of ICICI Securities. ICICI Securities started doing the peer-to-peer lending. Cred started doing the peer-to-peer lending. BharatPay started peer-to-peer lending. All these three companies are not peer-to-peer lending licensed companies. They partnered with one of the licensed companies and safely staying away from the complaints and license. And making the startups or peer-to-peer lending companies take care of the license. So what I see, the current peer-to-peer lending NBFCs will become more like a technology companies and compliance companies, and the business will be done by the large players. NBFCs are struggling to find new borrowers and raise funds. Large user base companies want to offer fintech services and earn alternative incomes. So what we are seeing is demand from loan seekers. Who is taking the loan? Merchants, businesses, salaried individuals are taking the loans. Who is giving the loans? Banks are giving the loans, securities companies are giving the loans, wealth and user aggregators are giving the loans. So this is what exactly our Raman Aggarwal sir said. The technology will bridge. The technology is already bridging, and today we are developing kind of units where people can just put a fingerprint and give their credit score and then find the offers available and take the loan. So this is already happening. So 2047, I only see this happening more by drones. Like a drone will come to your home and then it will take your fingerprint and then say, look, you have a loan facility. Why don't you do it? So technology will take us like, no, you cannot even guess. I mean, sometimes I say, I don't know where technology will take us, because banking services and IoT services together, it is going to completely disrupt. But let's stay on the ground and let's see little more what can happen. So by 2047, all large players will enter into peer-to-peer lending. For example, securities companies have a huge user base. They will ask their companies to lend money and they will ask their users to borrow money. And the transaction happens on the RBI guidelines. So the partnership with the peer-to-peer lending will play a vital role for them. Similarly, insurance company policyholders, you might have already seen there is a paper notification by IRDA where the policyholder can actually take a loan and pay the premium. So policyholder can lend money and policyholder can borrow money. So all the insurance companies will also enter into the peer-to-peer lending. Payment gateway companies, we have seen that Bharat Pay and Cred already entered into the market. So they have the merchants, they have the users, they have a large base. They will enable their large base to lend money and borrow money. So we have also seen the madam talking about the deposits. So this lending is nothing but a deposit. The deposits decentralization has already happened, and OEMs and dealers and retailers. So we may see that OEM, as of today, we have the OEMs like Mahindra. Example, Mahindra has tractors, cars, and Mahindra also have a finance company, their own finance company lending and the borrower borrowing. Now the new trend could be the OEM, dealer and retailer. Anybody in the chain can lend money and anybody in the chain can borrow money. The same thing can happen in the building material and supply material, because every user, as per the RBI guidelines, can lend money like a bank. So one last thing that I want to ask the elite panel and the EGROW team and EGROW masters, that peer-to-peer lending as tax saving instrument. Currently, the peer-to-peer lending is not a tax saving instrument. In UK, the peer-to-peer lending is a tax saving instrument like a mutual fund. Today, if at all we invest in a mutual fund, we all know that it comes under tax savings. The moment the peer-to-peer lending become a tax saving instrument, trust me, by 2047, the banking and NBFCs all will go around the peer-to-peer lending. Every individual will lend at their own rate and every borrower will actually bid and take the best loan. So I see that 2047 is going to be lovely and very great for the technology companies and especially the peer-to-peer lending companies, because they have a higher opportunity to fulfill the gap of both lending and borrowing. Thank you very much.
Thank you. Very interesting and futuristic. But maybe later on, I will ask some questions about this. Like
Yeah.
what is the Chinese experience? Internet lending, there have been a lot of scandals and so on. How do you make sure that doesn't happen? In lending between families, there used to be this thing of trust, and that would be, like I say, the best way to lose a friend is to lend to him, right? So now you have everybody lending to everybody, and somebody who does not, I mean, there is the risk, market risk, or If it's collateral based, then there's a problem of exclusion. So we need to think through this carefully, like what is it that's required to make it work? What have been the snags in countries that are, more down the path? Okay, so let's first listen to Umesh Revankar, who is Managing Director, Shriram Transport Finance, and has really valuable experience in the development of this financial services. So let us hear where he sees the future can be. Thank you.
Thank you, Ashima ji. Thanks to EGROW for inviting me to be part of this esteemed panelist. The way I look at the NBFC, see, we are a bit traditional lenders. When I say traditional lenders, we are almost there for more than 4 decades and nearing 50 years of being in the service. So the outlook may come out as more traditional, but the way NBFC has grown or the NBFC industry has grown over the period, if you observe, most of the NBFCs have played a pure play or rather niche segments. They focused on niche segments. They focused on building the expertise. They have been geographically focused and always tried to understand their customers and build the business around them. That has been the strength of the NBFC. Now, that's where the comparison between banks and NBFC comes. Banks are normally a generalist. They are supposed to lend to everyone. They're supposed to open account to everyone. They are supposed to give offer all kind of service to the customers. But the NBFCs can be focused. They can understand the business of the customer. Thereby, they build partnership with the customers. So therefore, the NBFC model in India so far has been a little different and more of a specialist. Now, there are four broad NBFCs, if you can break it up. One is financing against vehicles or assets or machinery, which are earning proposition. Second, lending against gold, which is a very short term, just to overcome a financial requirement for 3 months or 6 months. Then the third one is little longer term, which is basically a mortgage or LAP, loan against property. And of course, the final one is the MSME, which is now maybe last 10 years, NBFCs are started building on MSME separately on the cash flow basis, because earlier MSMEs were lent by NBFCs mostly on LAP basis or maybe on trust basis. But now in the last 10 years, because of the data being available, it is on cash flow basis. So the NBFCs are evolving themselves as far as the MSME is concerned, but the rest of the business are little traditional, which they know, and they have that kind of expertise. Now coming to the business which we are in, we are mostly in transport financing, financing to commercial vehicle, tractors, agricultural equipment, the construction equipment, taxis. That's the way we have built business. Now, if I look at the ownership of these assets in India, nearly 70% of the ownership is with the small individual operators. And last 30 or 35 years, I'm in this business. Every 5 years, people told me that it is going to change and individuals will not be able to afford to own. So it will be corporatized, it will get formalized, and maybe individuals will be out of the business. But in India, the entrepreneurship, the spirit of entrepreneurship, wanting to be entrepreneur or owner of the asset is much more driven. It is true to some extent across the Asian countries. So I think this leads even a driver wanting to become owner, a farmer wanting to have some machineries or equipment, and a transporter sometimes moving into construction contract business. So people move into this because they would like to become a owner or the entrepreneur. And because the society in India respects the entrepreneurship. If you look at somebody, if I see a driver is making X amount, maybe a 25,000 rupees, a owner of the vehicle also will make only 25,000 after paying the EMI. He will not make more. But the recognition to him by society is different. He is owner of a vehicle. So this makes people proud. See, whether it is MSME business or any individual entrepreneurship he enters into, around 80% of Indian community or Indian society is moving towards entrepreneurship and trying to build their own business. They are not dependent on job. The organized sector providing job or government sector providing job over the period is coming down. So everybody is trying to look after himself by trying to build a business around him. And not only that, earlier there used to be a single breadwinner in the family. But today I see multiple people earning. They are not happy with one people earning. There are multiple people earning within that among the household, and maybe many times businessmen they live together, and therefore they help each other in building business. So therefore I think the NBFCs have played a role and playing a role and going to play very important role. So coming back to the transportation industry, the way I look at India being futuristic in 2047, when I look at the India has long coastal line and it can become a logistic hub for the entire world, because we have a east which is a China face, and we have a west which is maybe a developed Europe and US face. So if India builds its infrastructure properly, because government is definitely doing its bit, and if you look at last 2 years, or even this year's budget, government is talking about investing 111 lakh crore in building infrastructure so that India becomes hub for logistics, manufacturing, and maybe trying to become trade hub. See, the tiny countries like Singapore and Dubai, such a small tiny countries, just by providing a transport hub, they have become so rich, they have become so powerful, wealthy. So I feel India can do much bigger by being a point of transportation to the globe. And in fact, China is trying to counter it. In the sense, China is now, if you look at the way they are trying to build a port in Pakistan, they're trying to build a port in Sri Lanka, trying to have control over Chittagong port in Bangladesh. Why they are doing it? They want the trade, control over the trade and movement of the goods. So India has huge scope and opportunity to really make it happen, because India is naturally there. It need not really go to some other country to build it. And of course, India is also trying to strengthen the relationship with Iran through Chabahar port, and also trying that north-south corridor, transport corridor, which recently opened up, which reduces the goods movement by around 10 to 12 days. It is nothing but you are reducing the cost of transportation. The logistics cost of India on manufacturing goods is 14%, which is very high compared to international levels, which is 8%. That means around 6% we are spending more on logistics. In fact, the transportation is only 6% out of 14. The inventory warehousing is 4 plus 3, 7%. That means there is a lot of inefficiency in the system. If there is a proper infrastructure, if there is world-class movement of the goods and the port and the road infrastructure, I think we can really reduce it and make it. So what I'm trying to drive is there is a huge scope and opportunity for the NBFCs which are focused on financing this industry, because overnight banks will not come and do that lending. The individuals, which are 70% of the total ownership of the vehicle, will continue to remain. There could be a small change, but they continue to remain, and individuals are best served by NBFCs, and the NBFC will have a much bigger role to play throughout, is what I feel as far as the transportation industry is concerned. And as far as the scope for NBFC, I just look at USA, where there are around 18,000 banks and thrift association, and there are other kind of credit unions. Around 18,000 various entities are there for a population which is around one fifth. And in India, we have very few banks, and that also public sector banks getting merged. What is happening is when the public sector banks are becoming larger, they find it difficult to do the retail lending effectively. Over the period, they graduate into more of a wholesale banking, and therefore there will be a huge scope for NBFC to continue to thrive. And India, the data asymmetry is quite large. I don't think that we will be able to bridge it, because in US, even in spite of having 18,000 credit institutes, 20% are underserved. And if I go by just the one example given, that is only 1 out of 18 loan is getting sanctioned, that means 80% or 90% are underserved or unserved. So there is a big scope for the NBFCs to bridge that gap, and I feel that's where the importance of NBFC will remain. And as far as the sources of resources, which is something some of the NBFCs have probably in the past would not have given attention, I feel NBFC have to have a proper arrangement or proper identified sources of raising resources all the time. So now there is a new ESG framework, and through that, a lot of money is coming. That is one big opportunity. And also, luckily, we are a deposit taking NBFC. We have enough scope to increase our deposit portfolio, which probably would not have given enough attention. So there is all these different sources need to be developed. You can't be just depending upon a bank or maybe a capital market. That gets skewed when your focus is skewed. Then you will definitely have a challenge. So well-defined liability sourcing is very important for NBFC. So I feel 2047 NBFC will continue to grow the same speed or same growth rate as it has been growing in the past 10 years. And the technology will definitely help the NBFC, because it will be mostly wedding or of technology with NBFC and bank, that will give rise to the servicing ability. Why every shop? I feel that every mobile is a POS, point of sale. So that is going to be the way the future is. So these are my few words. Thank you very much.
Thank you. So I think that is a good lesson on the importance of relationships as compared to technology, and how that can be expected to continue in the future. But so Shriram Transport is thinking of expanding into maritime, into ships.
Not yet, but definitely I think that is the way we should go. Because being at financing to transport, we need to look into all opportunities. I'll definitely will look into it.
No, because Gati Shakti, they are emphasizing inland transport in a big way.
Yes.
Rivers and so on. And there again, so this dominance of individuals. But you have these aggregators like Ola and so on, but they haven't been able to last somehow. So individuals, it's correct. I think that individual entrepreneurs will remain important to them.
Now, here the point is, even in Ola and Uber, the most successful operators are all individuals, aided by technology. when they own their own vehicle, they find it difficult to succeed, Ola and Uber. But individual operator who are working on that platform, they are successful.
So they get some aid from the platform, but then they're still individual.
Yeah.
Okay, so now we will go to Pankaj Sharma, who has worked with L&T companies like L&T and Citibank, and he's been president and CRO for Relicare F Invest. Is it pronounced as F Invest or Finvest or what?
It is Finvest,
Finvest? Okay.
Religare Finvest, and yeah, currently I'm the CEO of Religare Finvest.
Yeah, currently it's CEO. So we look forward to your perspectives on the risks in this area and how does because you have worked in that area also, apart from the general perspective.
Sure.
Please go ahead.
Thank you, Ms. Ashima. Good evening to all the panelists and the other audiences in the webinar right now. Thank you very much, EGROW, for giving me this opportunity to share my views and thoughts. And as Ms. Ashima actually has very rightly pointed out, and maybe she has observed, that I actually come from a risk background, so I'll be talking more about the risks and challenges for the NBFCs. But at the same time, I am very, very optimistic about the future of NBFCs. Before we jump into what NBFCs will be in 2047, because as they say, I mean, future is so uncertain and it's so unpredictable. Anybody daring a guess or predicting the future is only going to make a fool out of himself. So I'm not going to dare that part. If we just look back in the last 25 years, how the NBFCs have actually evolved, they have only grown strength to strength. And as Mr. Raman was also pointing out, and if I may use that a small clip in Hindi, कुछ तो बात है रजा हमारी हस्ती हमारी मिटती नहीं. So I don't think as NBFCs are ever going to die or fizzle out, and this sector has been very, very resilient. And the reason, there are many multifold reasons for the same. It's not just by a stroke of luck or by fluke that NBFCs have continued to be in existence and has grown in strength. If we look at the credit intermediation, which has traditionally happened in our country, this is a very, very critical component which has been catered to by the NBFCs. Look at the credit to GDP ratio in our country compared to any developed country. We are hovering around 60 odd percent. And if we look at the developed markets, they are in excess of 150%, 200% plus for China. If you look at mortgage to GDP, again, we are at about 10%. And if you look at the other countries, even for that matter, Malaysia, it's at 30% plus. And US, UK will be 60% plus. So there's a huge credit gap. There's no dearth of opportunity. And as Mr. Umesh was also mentioning, that there are only fewer lending institutions in the country who can really cater to this kind of a need. So very clearly, while NBFCs may have been around 20 odd percent of the total credit market, but this 20% or 25% is been very, very critical to the overall economy. So we are the most important cog in the wheel, I would say, the economic wheel of the country. And how have we actually created, as an NBFC, how we created this space for ourselves? NBFCs have typically looked at the niches, and who knows it better than Umesh ji, who have actually made a success out of funding the first time users, and that too for the second hand trucks. In City, we have worked very closely with Sriram, so I know exactly how the model works, and I have lots and lots of respect for this kind of a model, which Umesh ji just kind of briefed. So NBFCs have really created niches for themselves where they have looked at specific segments, specific geographies, and made a success out of that. So NBFCs have become, in a way, specialists vis-a-vis the generalists, which was being referred to in the earlier talk. So the two key differentiators for NBFCs vis-a-vis the banks have been the agility and the flexibility. Agility to reach the customers fast, agility to collect from the customers quickly as per their cash flows, will not wait. Like microfinance has actually shown that you can actually do weekly collections. Will the bank ever do that? Banks will continue to sit in their branch offices and will wait for the customers to come and deposit money. But NBFCs, on the other hand, they have gone out to the customers because that's the kind of relationships that the NBFCs have made, they have nurtured, and they've grown along. So today, if you talk about the bottom of the pyramid in the country, barring the few like pandemic, like black swan events, they have been the best paymasters. The repayments have been the best in case of MFIs. They are 99% plus collection efficiency they've shown. And that's despite demonetization also happening. There are a lot of hiccups which came in the way. But the intent of that particular segment very clearly establishes that what relationships NBFCs have made and nurtured over a period of time that can withstand the test of time. So that's the agility I was talking about. The flexibility is where the banks will typically look at the balance sheet. The approach of the NBFCs will be cash flow. They will just follow the cash wherever the cash is, and that's the way they will do the assessment on the customers. And with more and more democratization of the information, which is like GST inputs coming in, the CIBIL inputs coming in, the various tax inputs coming in. So all those parameters on the data that are available today to the NBFCs, they are being very well leveraged by them to lend to the underserved or unbanked customers now. And that's where they have really made a mark for themselves and also made sure that their respective business models are successful. So these are the two key aspects which have differentiated the NBFCs vis-a-vis the banks. At the same time, when I talk about that NBFCs have made a mark for themselves and they have been very, very successful, there have been a few challenges. I would say not, they may be few, but they have been very, very grave challenges, I must say, and which actually threatened the very existence of NBFCs. And that's why the questions, they keep coming up on why NBFC sector. In my view, the biggest one has been the lack of corporate governance in the NBFC sector. And that's what Ms. Ashima also in her opening remarks referred to. But the kind of greed that was shown by some of the promoters or the top management in a few of those NBFCs which failed over a period of last 3 to 4 years has actually led to the downfall of the sector to an extent and raised these kind of serious questions on the existence of NBFCs. And a link to this was also the lack of risk framework in most of the NBFCs, where we never had an approach on a holistic enterprise risk management framework for the NBFCs. And because of which the asset liability mismatches happened, the liquidity mismatches happened, and because there was a drain of liquidity in the entire sector, the larger NBFCs faced a lot of issues at that time. They failed because of the other issues as well, as I mentioned earlier. Even the smaller NBFCs faced the same problem because they also got tagged along with the other large NBFCs and their sources of funds dried up. So these challenges which came up for the NBFCs, what is it that can be done so that in the next 25 years, the sector doesn't face these kind of problems? As rightly mentioned by one of the speakers, that self-regulation, and that's what I think FIDC also has been striving very hard. And Ramanji would be bearing with this piece. Sorry, is there a question in between? Okay. So that's where I think the NBFCs really need to get their act together to regulate themselves better. And at the same time, I would also have a very strong urge to our regulator that, of course, they need to regulate this particular sector, which they have been doing. And of late, we have seen a flurry of regulations coming in with the scale-based regulations being announced. Regulator also needs to be a partner for this sector.
Please off your mics. Can the host off everybody's mics? Everybody's mic is on. Please carry on.
Sure. So if we look at NBFCs, we have not been having a very level playing field with the others. Within the lending community, if we look and compare ourselves with the banks, I'll give a small example. I mean, like TDS, it's an irritant for all of us. We look at QRILC, where we supply information and data to this governing bodies, QRILC, for greater than 5 year for greater than 5 crore exposures. Now we supply this information, but we don't have access to that information. So these are very critical ones, but small irritants which can be quickly addressed. I don't see any reason why it can't be done. And our primary regulator, which is RBI, if actually acts like a partner to us, and takes up our causes, not only FIDC doing it, but I think if RBI can also partner in some way or the other, where they can really help this sector come at par with the other lending institutions, where they are enjoying these kind of arbitrages, if I may say so, that they can actually go access Skrill on the click of a button. They can decide whether in the larger exposures they can take this kind of exposure or not, but we can't do as an NBFC. So these are the things which can be, I think, addressed with our regulator. The very important aspect which was touched also was on the bridges to be built, where we actually have an ecosystem which is based on the collaborations and partnerships. And co-lending was one of those regulations which was announced by our regulator. And that's something which can hold us in good stead as we move along and go forward and move towards 2047. So in my view, if I have to just kind of encapsulate as to what is it that NBFCs need to do to be future ready for 2047. First and foremost, I believe is the corporate governance standards. They have to be very, very transparent, and the risk management framework has to be extremely tight. If we don't do it ourselves, somebody else will do it and we will not like it. And that's precisely what RBI probably is trying to get at. And quite a few of us, I mean, in our informal platforms, I have been also hearing that why are they getting into this? Why are they trying to control the remuneration? Why are they trying to control that this is the way our hiring should be or whatever it has to be? So if we are not setting our own houses in order, somebody else will, and that's something which we need to avoid and look at it ourselves. Second, I believe is the technology front. I think it is changing on a daily basis. Lot of dynamics on the IT front. So the earlier we digitize, the earlier we bring on those technology platforms as enablers. Because I personally believe and firmly believe that we will always have a combination of physical presence and a digital model, which is basically, some people also call it as a phygital. Now, whether the proportion will be 60-40, 80-20, 90-10, that depends on the period of time, the quality of data, and all those aspects to it. But I will not comment on the quantitative aspect of it. But yes, there will be, I would say, a combination and a good, healthy combination of physical presence with the digital world that we are seeing right now. And that's the way to keep ourselves ready or make ourselves ready for the future innovations which will come along our way. And third is, as we all know, that data is a new gold, and everybody is trying to analyze it in a manner which is conducive to taking decisions. So analytics-based decision making will be the third very important aspect for NBFCs to make successful models for the future. And as I mentioned, that in our ecosystem, we have to now look at the collaborations, building bridges, which I think Mr. Raman was also pointing out. A very, very key aspect for NBFCs to look at, instead of competing with each other and fighting it out and going into, if I may call it, as a berserk lending, where we throw caution out of the window and then end up having huge credit losses and not able to then make up for them and not able to absorb because the capital adequacy norms are just about there. All those things actually feeding into each other, and we go into a downward spiral. So the best thing to do is to collaborate, to build partnerships and ensure that we survive together and thrive together as we move along, because there is enough and more space for all of us to not only exist, coexist, but also to grow. And finally, the point which I have also been a proponent very strongly in my own organization is the employee first, which is being able to attract talent, is to retain talent and nurture the talent. This is where I think, going forward, NBFCs are definitely going to face a lot of challenge also, because there's a huge competition coming in from the private as well as the public sector banks, because they're also opening up, public sector banks. And there is a huge drain on the talent, because NBFCs are being used as a good training platform for the talent. And once they have been trained, whether it is an MFI or people who are engaged in the MSME lending, there are ready-made talent for the banks to absorb and take them on. And the kind of perception or the optics that is built around that you are a banker instead of working with an NBFC, it actually plays on the minds of these talented people. So this is another challenge which I believe NBFCs will have to really look at closely on making sure that they are able to attract talent and retain it to nurture it for the future. So with these words, I would like to conclude my opening statements and will be open to question as and when the house is open. Thank you very much for giving me this opportunity, ma'am. Thank you.
Thank you. Well, very good points. I think combination of everything, physical, good word, and self-regulation, regulator, bridging. So, but one of the things we say about the financial sector is there's a lot of risk aversion and suspicion, the experiences of the last decade. So how are we going to overcome that and build trust, build these bridges, work together? Yeah, anyway, that is a question for everybody among other questions. But first, let me invite Dr. Charan Singh, you have some remarks? See there? I think he's in this chair. Yeah.
Honestly, I'm mesmerized with the amount of points that have come up and the issues that have been put on the table. Means I never looked at it from the angle of peer-to-peer, and I'm very impressed with that model. On transport finance, I did not know that the coastline can be used, and this is really interesting what he has mentioned. Risk assessment with Mr. Pankaj was mentioning. Means I'm very impressed with what is on the table. My own feeling is, and here is a question, maybe I'm still very traditional, very conservative, or maybe I haven't, because I'm not from the same profession. Maybe my question is little naive, but I was wondering, in the whole scheme of things, if I look at credit to the credit ratio, and I look at market, say 80% of it is now being covered by the commercial banks. And if you look in America, and I look at the credit flow in America, the shadow banks accounted for nearly 50% of the flow of credit into the system. Up here in India, we're just around 20% that NBFCs are contributing. My thought was, would anybody be able to say, in terms of the overall growth of the economy, say 25 years from now, and say $20 trillion or say $40 trillion, whatever, the requirement that the economy would need, because NBFCs are catering to the informal sector, any such thoughts that how much would be the volume, what would the size of the NBFCs, what type of NBFCs would we need, so that like America, where 50% of the financial requirements are met by the shadow banks, in our country, are we thinking, do we have NBFCs that can handle that much of pressure or that much of demand? Thank you.
Any other comments or questions? We can collect and then we'll have a reverse round. Dr. Boy, I see you there. Any questions? How are you? There's a question here in the chat. There, that 2% rate of return on a monthly basis. What is the level of defaults in the P2P? And how do you do due diligence in the technology-based lending? So I'm thinking we just collect these questions, which we have, and then we'll do a reverse round, yeah, of the panelists. So among the issues, I wanted this discussion of trust and bridging. How is it going to happen practically, given the sort of risk aversion and suspicion where banks even today are not lending to NBFCs? We are seeing that wholesale credit, because of the NPAs and so on, is going down from NBFCs. So how is it going to come up again? And we talk about cash flow and fintechs, but still I was horrified to see recently that the cost of lending by these fintechs is something like 28% because the transaction costs are very high. So the idea of using technology should be really to bring down costs. Maybe the cost of borrowing is high, maybe co-lending, and if they can build bridges with banks so that banks don't rely only on ratings, but also on relationship and give cheaper loans, or there are other sources of finance. Because ideally, the cost of lending should also come down using technology as well as relationships. So then specific suggestions for the regulator. There were some good suggestions from Pankaj Sharma. Apart from that, and how is corporate governance going to improve for NBFCs? Is there what are the self-regulate? What is FDI? What is the industry body doing? FIDC? What is self-regulation? Because there are always some, what is it? Bad, rotten apples that infect the basket. How are you going to make sure that they are taken out or they don't contaminate the basket? And that, because with this P2P trust is very important, where you have a lot of people coming in. How do you maintain standards there, apart from the role of technology and better data? And exclusion, those who don't have collateral, where data is not available, or will will exclusion come down? Do you see that coming down? The universe of people getting credit will expand? Okay, thank you. So we'll start with Pankaj Sharma. Just take any of these questions you feel like answering.
Sure. So I think trust is something which I would like to take up. And this is something which I believe is supposed to be the cornerstone for any lending institution, be it NBFC or a bank. We go to a bank only if we trust it. We'll place our deposits only if we trust it. And over a period of time, banks may have developed that trust because there is a backing from the regulator there. Their deposits up to 2 lakh or 5 lakhs now is insured. So we know if it is state bank, then state banked, I'm saying, and the state backed, then we know that there is somebody who's really backing it up. So there's a sovereign kind of a guarantee for all the deposits. So that's the element of trust with the banks. What is there for NBFCs? Nothing. We have to develop that level of trust with our stakeholders of our own accord. I don't think as NBFC sector, independent sector will be ever given that kind of a tacit or an explicit sovereign guarantee that, okay, I am standing behind you and anything happening to NBFC, I'll come to your rescue. Nobody has ever come to the rescue of NBFCs. They've let them fail if they are not really deserving to succeed. And that's what has happened. So how do we build trust? Because one event of ILFS has actually taken that trust down and the deficit now is huge. And it will take us time to build that, to rebuild that. And I think FIDC is doing its bit, but each one of us are also responsible and accountable for building this trust back. How do we do it? My view, there are various ways of, not various ways, I would say, there are more than one, I would say, steps or actions that will be required. Starting with the top, where the board has to be very, very competent and independent, where they will have various committees to look after the various risks in the organization. Lending is all about managing the risk. And if you are able to identify and manage that risk, I think by and large the problems will be solved. Issue here is that we only go after the customer and look at a business strategy as a pure independent business strategy. If we look at any of the NBFCs today, very few will have a very well-defined risk appetite statement. Now, what is it that I can actually absorb as a risk in my organization and then dovetail that with my business strategy? Very few NBFCs would be doing that way, where they approach the market from a risk angle and then say, okay, this is the amount of risk I can take on my books, and these are my red lines or boundaries which I will never cross. And within that, I will frame my business strategy and will go whole hog. And any customer falling in that category, I will go do everything for that customer. Because I have very well-defined boundaries now. I will not go beyond that. So at any point of time, you know what are the credit risks you are taking. You know your liability risk, that what you are taking on them. And accordingly manage your asset liability mismatches, etc., etc., etc. But this has to be driven right from the top, which is the board is I would say, the topmost body in any NBFC or in any organization. Let them define all of it for an NBFC, and then percolate it down to the last person in the organization. And that's the way you can really run it all through, percolate it, and there is a uniformity of thought made on these aspects of running the NBFC based on the principles that I just mentioned. Once we have done that, ensuring that the compliance risks are completely taken care of, you have a zero tolerance to the compliance violations or regulatory violations. Automatically, the key stakeholder in any NBFC is the regulator. Once he is also on board that this is the right way of running it, and they are completely transparent in their dealings with the regulator, automatically the trust will start rebuilding in the entire ecosystem of the NBFCs.
Yes, I
That's
think that's right. And we're seeing that there is learning because, as I was saying in the FSR, there's a much better picture of the liabilities and there's no kind of arm mismatch, etc. Buffers have been built. So all of this builds confidence in NBFCs. So I think that it is on the right path and there's learning from the past and a lot of improvements. So for Umesh Revankar, there's a specific question also that what is the level of defaults you experienced in the vehicle financing during the COVID period, since transport operators were one of the worst hit during the COVID? This is a question in the chat.
Yeah,
So any other question you want to pick up in this one?
Yeah, thank you. By and large, what has happened is during this COVID, when the government and RBI both together try to support and help, and 5 months moratorium were given, most of the issues were addressed because what happened is many of these transporters used 2 or 3 months of the moratorium. They did not use the 5 months, but that was a time for them to recoup themselves. And most of the essential goods were transported. It was never stopped. Their earning would have stopped in the first 14 or 15 days when there was a chaos. Nobody knew what is going on and unsure about going to different places. So that is the only period of uncertainty. And they have, because of the essential goods transportation, and India it never faced shortage of any essential goods throughout that COVID. So people bounce back very fast, and we now we see that most of the transporters are pre-COVID level.
Yes, that is true. I think our recoveries are very good, and people talk about the lockdown, which was only a couple of months, or 3-4 months, and after that, business recovered. Actually, NPAs went down on a whole for the financial sector. But any of the other questions you want to take up?
I would like to take up one thing. I feel you did mention a word, this one sentence saying that lenders of last resort, RBI being lender of last resort. That is something I feel it has to be done because it gives that confidence to banking system to support the NBFC. Otherwise, I always there is some kind of a doubt, and people would feel too risk averse to lend to NBFC, especially a smaller NBFC. So I think RBI need to think on this line and come out with a policy so that by the entire financial system is very confident about the lending to NBFC and NBFC ability to get over any short-term challenges. That's the only suggestion I have.
It can go along with holding more assets. Yeah, it's part of the overall improvement in the finance. So next we go to Radhakrishna. A lot of questions on this P2P and so on. Yeah.
Yeah. Yes, ma'am. It's fairly new sector, and we are a technology company, and we learned the finance, and then we understood the finance from the people aspirations. Today we look at when the debt burn ratio is 50%, 65%, 70%, they are not able to get the loans from banks and NBFCs. Then the last resort for them is come on to these peer-to-peer lending platforms and tell about themselves. And I'm quite excited with the kind of information they give for a small amount of 20,000 rupees and 1 lakh rupees. Okay, and up to 10 lakhs. So many of them are entrepreneurs and small entrepreneurs and who are actually earning a good money out of it. So what they actually earn a good money if the day is good. Okay, the small entrepreneurs, they earn, the traders, they earn 5 to 8% per day. Okay, so for them, paying out 2% per month is not a problem. For them, if they don't lend, if a bank doesn't lend, if a friends and family doesn't lend, they don't have an opportunity. So what we have seen, the peer-to-peer lending as a last resort, and which is building a lot of trust. Like, no, the one word that I want to pick up from the whole discussion is the trust. Somebody has to trust them and hold them, and then make sure the lender is giving a money. So today we have seen, like, no, in the last 4 or 5 years on my platform, uh, leaving the COVID loans, like, no, initially we have done the salaried class. So salaried class, the moratorium, that little got disturbed. Okay. But after that, the rebounds was very good. Like, no, we moved on to the supply chain and we moved on to the small entrepreneurs. They actually paid back. And today, it looks very different for me to say there is zero NPA in the last 2 years. Because the way we handle got changed. The, like, no, we said we are there for you. We'll talk to the lenders. We'll bring small money from the good people. See, coming from the IT background, my fraternity is a technology fraternity. And then I said, look, we get 2 lakhs, 3 lakhs salary. Can we take some 50,000 out of our pocket and lend and give it to the 10 people? And out of that, 9 people return with the expected returns, you are still positive. So the rate of interest are a bit high here. It starts from 18%, 24%, 30%, 36%. A entrepreneur with no credit risk, sorry, an entrepreneur with no credit score, we don't know how to analyze him. So we say, okay, we'll start with the typical loans that you see in the market. Like, no, we start with giving 10,000 rupees per a interest rate of 3% per month, not even 2. Okay, we are taking risk. Our lenders are taking risk. So at the end of the day, when they pay back, it's actually a festival. Okay, we actually celebrate it. So last 24 months, and it was a huge celebration because we helped farmers, we helped small time auto people, we helped the people who are doing business on the roadside. Two, we have helped the people who are actually doing the food processing and all. So the actual returns that we have given is 28.5 percentage. This has become a good norm. Like, no, it's not just me. And before entering into this session, I actually purchased the ROC documents of all my peer-to-peer lending companies, and I looked at their NPAs and their reporting. And average, there was a 21% returns given to the lenders. So this is a new age where the lender is taking a small risk of 50,000 and 1 lakh, and we are bringing the trust that, let's trust the borrower. Give them 50,000, give them 5,000, give them 25,000. While we are doing this, the companies like BharatPay, they entirely change the game of enabling their own merchants lending money and their own merchants borrowing the money. But there, the rate of interest is only 12%. So we are also trying to see how the aspirations of 3624 can go down to 12. But any one failure also we cannot handle there. The problem is, out of the 10 loans, if one loan fails, it doesn't even get its principal back. So if you try to solve the higher interest rate problem, your principal is at risk. So continuously what we are building is, we are building the trust. And today the sector has actually delivered $1 billion loans, which is a very good uh, milestone for the peer-to-peer lending sector in India. So the two big things is, in UK, peer-to-peer lending is considered as a tax saving. Somebody lends money, they can show it as under tax savings. And in Dubai, okay, the government is saying that it will come like a mudra loans. If a borrower fails, the government will pay the loan on behalf of the borrower. So such kind of instrument was given in the Dubai, and I think such kind of instruments for peer-to-peer lending at certain risk coverage. Like, no, if a lender taking 50,000 out and serving the economy, somewhere we need to find out an instrument that can safeguard his certain percentage of money. If the government can look into the tax savings and the credit policy for the peer-to-peer lenders, I think this vertical will flourish huge way. I'm talking about, like, no, recently we have celebrated one of the banks completed 106 years. So look at peer-to-peer lending in the next 100 years. So this is where I am amazed to see 2047 vision. Technology will rule. Everybody will have a handle to the mobile. They can lend money with one swipe, and they can take risk. Their appetite is increasing. Okay. So I think government has to look, because government is not looking peer-to-peer lending as a very big sector, or they are not even considering it as a sector. So there is no attention. If you can throw some attention and say that, can we consider the peer-to-peer lending as a tax saving? Can we give some kind of credit support backup for the lenders who is taking all the risk? Over to you, ma'am. Thank you very much.
So isn't there some way of, say, you're charging 28%, but when a person repays, if he repays, then he gets a bonus or something, so that the amount charged is less, no? Something like that also to reduce. And is there any pressure on the borrowers to repay? Because
yeah, see, what generally we do is, these are all 30 days loans and 45 days loans. Fast fail and fast succeed. The person who is repaying, the 36% will come down to 30%. The person who is repaying 28, but 24 is a stoppage. If you go below 24, even a small failure is giving a big impact. I mean, not a positive but a negative impact. So there is a method to control, but I think we are talking to the many individuals, like who can actually put up at 18% and 12% also. Then there are different players in peer-to-peer lending. Completely, it's a donation based. They donate money. It's a debt money only. It's not a complete donation. They give it as debt, but they don't. They say, okay, Radha, if the borrower fails because of various financial pressures and economic pressures, don't put hard on him. Okay, let him relax. So there is a kind of approach in peer-to-peer lending. It's a social responsibility approach is there, but that will not yield any financial outcomes to the platforms. What we have to see is the financial visibility for viability for the platforms. So today we spend a lot of money on the technology and the employees. If we don't enable the borrower to make money and lender to make money, we cannot charge the processing fee. So we have to make sure the lender is making money and borrower is also generating revenue. So then only we are actually able to make the processing fee. So yes, we have considered that time to time we have to bring the lending rates down, and the moment we bring the lending rates down, we can actually increase our processing fee. So looking at all the three parties, platform, lender and borrower, I see it's a long way to go. Long way to go.
as it matures, we might see some, as the credit history is built up, etc. Yeah. So coming to the final, the person who has the largest overview of the sector, Mr. Aggarwal, there are a couple of more questions come in. If you can also take a look, consider them. One question is that should an AQR be done for this industry? And why is it that NBFCs lend to riskier parties? And then the potential of an online dispute resolution mechanism.
Yeah, thank you, madam. So before I answer these specific, I'll quickly share 3-4 insights which will address the questions raised earlier. See, if you look at the history of the sector, while a lot of emphasis was given on the asset side of the balance sheet in terms of regulation, I think it was the liability side which got, if I can even use the word, neglected. And that is where the avenues of raising funds got restricted and tightened. So public deposits was altogether stopped. There were a lot of restrictions earlier in ECBs. There were restrictions, and we see the risk aversion on the part of bank borrowings. And we have even been advocating for the cause for creating a refinancing mechanism. So I think the need to expand the liability side is the key for, I think, to answer what Dr. Charan Singh raised the point in terms of the overall boom growth of the NBFC. So I don't see a challenge in terms of the market availability in terms of business. It's more restrictions on the fundraising, which is the real challenge, number one. Number two, added to this issue is a point which you touched upon, is the entire aspect of credit rating. Unfortunately, credit rating in our system, specifically for NBFCs, is a regulatory parameter. I can say that because for every fundraising avenue, credit rating is the first eligibility criteria. And ma'am, I think you would agree, nowhere is eligibility defined purely by credit rating. Even The government schemes like partial credit guarantee scheme, the first criteria was minimum prescribed rating. If you go to a bank for funding today, the first eligibility criteria is rating. So I think that needs to change, because a lot of small and medium NBFCs are not able to get ratings because size play a very important role in this process of credit rating, a fact which has been acknowledged by the rating agencies themselves. Number three, very key aspect which I think not very many people, madam, if you look at even the latest financial stability report, I'm talking about reporting of data on NBFCs. If you look at even the latest financial stability report, it says that the major segment of lending of NBFCs is to the industry and retail is number 2. Now, this itself is a fact which I'm sure everybody sitting here would not agree to. NBFCs are known to be financiers, retail financiers. Now, why this aberration comes up? Because the reporting of data on NBFCs by RBI, there the data reporting of public NBFCs, that means those owned by the government, is clubbed with the data of the private NBFCs. Because the same report also says that 85% of the loan given to industry by NBFCs is through the government-owned NBFCs. So that means it is the government NBFCs which are actually not presenting the correct data. It skews the picture to something else. Why I say this is because this became relevant more in terms of when data was reported for bank funding to NBFCs. There was a large chunk which went to the government-owned NBFCs also. And that is where, while data was saying that the bank funding has increased, something we all know that we did not see a matching increase of bank funding at the ground level. So I think these are 3-4 very important aspects which need to be highlighted. Now, coming to one more aspect is, madam, today we do not have a system of regular dialogue, structured mechanism with the regulator or with the government also. Although, with due credit, RBI doors are open in terms of whenever we've tried to approach them, but it becomes more of a firefighting exercise rather than a structured regular dialogue. Just as there is a regular meeting happening with the banking sector, there could be a regular mechanism, and this system was there in 1998 till 2006. There was an informal advisory group of NBFCs wherein the industry players were invited every quarter. Every policy was discussed threadbare, and then it was issued. So I think something that needs to be revived, and the same applies with the Department of Financial Services, Ministry of Finance. So those are 4 broad points I thought I'll share. Coming to the specifics, AQR. Now, AQR is something which really gained importance post ILFS. And let me say this with confidence that time and again, RBI denied this, and RBI did not agree to this data simply because the data available with RBI also showed that the asset quality of NBFCs was actually good and not something really to worry about. Because AQR for banks was carried out once we saw a spurt in NPA levels, the asset quality significantly came down and there was a need felt for AQR. But that was not the case for NBFCs because RBI has the updated data for all the NBFC sector. Coming to the online dispute, the dispute resolution mechanism, there let me say that a lot of work has been done by the regulator itself. We now have not only the ombudsman scheme open for NBFCs, there is also now a mandatory appointment of internal ombudsman by NBFC beyond a certain size. So apart from the grievance redressal mechanism to be prescribed under the Code of Fair Business Practices. So I think a lot has been done, and this process of grievance redressal in case of individual companies, a lot of it has become online also. There is no longer a greater need for the borrower to actually visit. Quickly coming down, things which have been raised about what has FIDC done. As a body, let me share a few things which we've been doing. Apart from RBI's prescribed code, we at FIDC have prescribed a code of fair business practices, which is being circulated and shared with the members. Yes, since we do not have a statutory backing of being an SRO, we are more of a voluntary SRO. In fact, RBI has been clearly to say that we are not a recognized SRO because there is no statutory backing. We are a voluntary role that we are playing. In 2008, when this whole unethical behavior of the recovery and repo agents became an issue, we at FIDC had done a handbook on repossession, which was prescribing the do's and don'ts of what needs to be done and what should not be done, educating the public at large and also educating the members. The same was also shared with the Honorable Supreme Court in one of the cases which went by. Third, we did sign MOUs with World Bank, where World Bank faculty conducted workshops for member NBFCs on credit bureaus, how the data reporting on credit bureaus is actually helping the NBFCs, and what further analytics can be used by interacting with the credit bureaus. And uh, finally, we at NBFC, in terms of talent acquisition, are now also venturing into engaging MOUs with some of the leading academic institutions across the country. The idea here is to start NBFC specific certificate courses and to ensure that we get a ready-made pool of talent which has understanding of the NBFC model, the regulation of the NBFCs, and how we are different from the banking sector and what opportunities we provide.
Good, thank you. I think all this is absolutely essential for a thriving NBFC sector by 2047. So you seem to be on the right road. Best wishes. Yeah, Charan, would you like to conclude the meeting? It's past 5. Are you there, Charan? Dr. Charan Singh?
Professor Ashima ji, Charan has gone in that Vigyan Bhavan, so he has asked me to conclude. Many panelists, some of at least them don't know. Let me introduce myself. I am Professor Ashok Vishwandas. I am the director in EGROW, and Charan has to go for a while, so I'm taking this privilege of concluding. Let me first thank you, Professor Ashima Goyal ji, for making very good opening remarks for your initial discussion, and the points were very rich and we really benefited. And thanks indeed for chairing the session, which were very useful. Let me also thank all the panelists and Raman Aggarwal. He made very extensive, very brief and crisp points. And then Radhakrishna ji, Umesh and Pankaj Sharma, all were very good. And then some of the audience also asked very good questions, and then they answered very, very briefly and to the point. I'm sure all of us benefited. It was a very rich exposition. And let me also add that tomorrow by afternoon, we will give the recording and give to everybody. And next week, on the same time, we will have the banking in 2047. Again, it will be very rich discussion on this, and it's very relevant. And I request and appeal to all our panelists, if possible, they may join. We will individually be inviting all of you to kindly join. With this, I thank you, each one of you, especially the chairman and the panelists and all the audience, for making it very lively and stimulating discussion. And thanks indeed. And on my own behalf and on behalf of EGROW, I thank you once again to each one of you. And with this, we call it we end this meeting. Thank you very much.
Thank you. I think we all learned a lot.
We learned a lot. Yes. Thanks. And all the panelists and chairmen made it very, very enriching.
Thank you. Indeed.
Thanks indeed. Yes.
Thank you so much.
Thank you.